Hey, hey. How we doing? How we doing? Hope you guys are doing great. Hope everybody had a good day today. Hope your day was good. I had a very good day today. It was very productive. And yeah, was productive. We got a lot done. We got a lot done. Listen, I want to encourage you to go ahead and share this video with somebody. We're going to be on here for a few minutes, just giving some more tea. I really want to. Hey, Garland, how are you? Um, I gotta see how's it coming with Juliet's house. One of my amazing contractors that are on here right now. And I just declare all is well with you, Garland. You're blessed. I declare all of you are blessed in Jesus' name. But yeah, I wanted to come on here and just kind of have that conversation with you all. I'm hoping that this is that every time you get on here, my goal is that your faith is enlarged to know that you can go out and live your dream. Like there's absolutely no reason why you cannot live the dream that you've always dreamed about, right? It takes sacrifice, it takes discipline, it takes determination, it takes consistency. And I think that's probably for anything that you want to be successful in, it's going to take consistency. It's probably why most people are not successful in certain endeavors. It really doesn't matter if it's real estate or science or art or, whatever you feel like you're called to is going to take a level of consistency and determination and continuing to show up and continuing to ask questions. And I think even more than that, staying a student. Like you just got to be willing to stay a student and remind yourself all the time, hey, I don't know everything. There's still things that I'm learning. And maybe I was doing something that was working, but maybe I need to make a little small adjustment. Maybe I need to make a little small tweak. A lot of times those little tweaks and adjustments can make all the difference. And then, of course, learning how to follow up. I'll tell you, probably I would say, number one, the grace of God is what has brought me success. And I still have a lot of growing to do, but also really being consistent, knowing how to keep following up, knowing that if it's something that you really want, you've got to kind of give yourself a non negotiable, whether it takes 1 month, 1 year, 2 years, 3 years. When you look at people that have had tremendous amounts of success and you study them, it wasn't that everything it wasn't about them being lucky, which I really don't believe in luck. I believe in the blessing. But the blessing can be present. But if you don't work it, right? If you still don't show up, if you still don't go after it, if you still don't keep a sense of urgency and patience working together at the same time, you're still not going to see the end of your faith, if you will. You still got to be the one willing to say, hey, I got to keep showing up for myself over and over again. And I'm getting ready to email someone, Sean, who's supposed to be coming on here with us today, which I don't know why he didn't see this, child. Like, why didn't you see this? All right, I just sent it again. Let's see. All right, I just sent this again. I just sent again. But there's so many different ways, Garland, to become successful in anything that you want to do. And one thing that I found is that one of the key reasons when you look at people that have had a tremendous amount of success, I think everybody hands down can say that they did not do it by themselves, right? Can you just say success is a team sport? Can you put that in the comments for me? Can you say that out of your mouth? Success is a team sport. It's not about you knowing everything. It's not about you doing everything. I think it's about being aware of what your strengths are and then also being equally aware of what your weaknesses are, and work on developing your strengths. I was listening to someone who's had a tremendous amount of success. Actually, it was Grant Cardone recently. And somebody said, you've done a lot of work on yourself. Like, how do you handle your weaknesses? He says, honestly, I don't spend a lot of time on my weaknesses. I spend more time, Teapot 5000, on developing my strengths, which I thought was really profound. And I think that's what everybody has to kind of find out and do. Put in there, success is a team sport. Success is a team sport. Somebody else put that in the comments. Say that. Figure out what am I really good at, and then, Carolyn, figuring out like who around me, like what are they really good at, and us learning how to play our strengths, how to work our strengths together, I think is most important. And so that's what I'm doing. That's what I'm continuing to do. I have a few very key relationships that have been pivotal. And honestly, I'm always adding on relationships that are going to be pivotal to my next level. And to a lot of you that connect with us, it'll be pivotal to your next level as well. And so, what we've been able to do here to Setify is create a community of amazing people, from contractors to relationships with other people that are scouting the market for off-market properties, single families, multi-families, title companies, because all title companies are not created equal. You want to make sure. Okay, he's asking me to send his email. Okay, let me do this, guys. Give me 1 second. I'm gonna email this to him really quick. Let's see. All right, because I want him to come on here and we have a conversation that I think will be really good. Okay, cool. But having all those relationships in place, so literally it puts you in a position to be able to like come in and plug and play. You know what I mean? That's what I want you to be able to do. I want you to be able to come in and do a plug and play situation where you say, okay, you know what? I'm ready to play. I need to just find the perfect off market property, because a deal is not a deal unless it's a deal. And then I want to be able to have the contractors that can help me from beginning to end. I've already gone through working through, contractors that did not deliver on what they say, and having that as a huge part of your success. Because if you have a contractor that starts with you and then something happens and God forbid they steal from you, or you find out that they're not good at what they said they're good at, and you have to bring somebody else in to go on top of their work, you end up spending double in your cost, where your cost was supposed to be 20,000, now your cost is maybe 40,000, which now begins to eat into your profit. And so having a mentor ideally helps to circumvent some of these things. And it doesn't mean that it hasn't happened to me, even with some of my students, but I've learned how to get real creative to help cut those costs off. Because the beautiful thing about having contractors that work within the community, they're also conscious to make sure that they're giving the best deals. Garland is one of them. He's going to give the best deals. I have a few of them that are going to give the best deals, because you don't want to just go and find a random contracting company from God knows where that you found on Google or whatever, and now you want to use him. And so now they're going to charge you astronomical prices. So it really does become important that you have that community. And so I'm going to bring on my brother Sean. We're going to kind of get into some good conversation. I live right behind the private airport, so we got a loud plane flying over us. But Sean, I'm excited to have you on. Thanks so much for jumping on here today. I want to jump right into it. You're an insurance agent, so talk a little bit about what you offer as an insurance company. And this conversation I think is important, because a lot of times when people think about insurance, they think, okay, that's a death benefit, and that is correct. But you really can use insurance to help to build an empire, to build your portfolio. And it's what we've seen a lot of the wealthy do, using their own money, their own interest bearing money, to build their portfolio. So will you talk a little bit about the different insurances that you offer?
Yeah, absolutely. So at the very high level, when it comes to life insurance in particular, there's two main types. There's term insurance, to where coverage or death benefit for a period of time, but after that time is up, you have no more coverage. Typically, people like it because it's cheaper, and you can get a lot of coverage for low cost. But at some point, it runs out, and there's no equity or value being built inside that plan. On the other end of the spectrum, you have what we call permanent insurance. And within permanent insurance, there's a lot of different flavors of permanent insurance. You have whole life, universal life, you have index universal life. And all those insurance are designed to be permanent in nature, meaning that as long as the premiums are paid, you don't outlive it. Okay. Now, on the permanent side, this is what you're referring to, Joel, when it comes to just building wealth inside of a life insurance contract. The first primary reason for life insurance, and to your point earlier, the death benefit. And I don't know what other asset to where you can put in, X amount and get maybe 5 or 10 times that when you pass away as a way to transfer wealth. But there's also living benefits inside of these plans as well. Okay. So what happens is these insurance companies take your money and they put it to work for you, right? To where you're getting some interest, you're getting some growth on the premiums that you pay, and it's building up what we call cash value or accumulated value that you can then leverage for opportunities while you're living. Okay. And a lot of times, when it comes to leveraging that equity, as I like to call it, you can take advantage of real estate deals or other opportunities that may come across your table. There's a famous book out there called "What Would the Rockefellers Do?" Have
What's
you
the
heard
name
that,
of it?
Jewel?
No, what would the Rockefellers do?
What would the Rock?
Okay,
Yeah.
that's good. I hadn't heard of that
So
one. Ooh,
this book,
name.
yeah. So and I got a lot more, but this is essentially the system leveraging insurance that the Rockefeller used to perpetuate their wealth until today. Okay, they created a trust. They put life insurance on John D initially, and when he passed away, they put the insurance inside of a trust. Now all the family have access to the trust money. Now, in order to tap into that trust, what you have to do is you have to take a life insurance policy out on yourself, and you make the trust the beneficiary. Okay, and you would borrow whatever money you need from that trust to start your business endeavor, to get into real estate. But when you die, because you will die at one point, the death benefit is going to replenish the amount that you put out plus more. And so that's how they're able to perpetuate the wealth inside that trust, leveraging life insurance. So there's a lot of different ways that you can leverage life insurance outside of just the death benefit. Equity is a main piece that you can leverage while you're living, and it's great to take advantage of certain opportunities while you have access to the cash.
Okay, so let's talk about that. And that's something Ben and our family put in play. I don't know, it's probably been about 7 years ago, where we had our trust set up, and then we set up whole life policies, and then also index universal life policies where we can borrow from them, still earn interest on that money, pay the money back. Let's talk about that a little bit, and we do have people that can help you set those trusts up. Recently, that trust system kind of came up under fire over the last year, where a lot of accountants that were offering it now can't offer it because they really tried to change the game up. Because I just kind of noticed when everybody started getting on stuff, that's when they kind of started changing the game up. You still can't do it, but you got to really make sure you're getting with people that really know what the heck they're doing, not just setting it up, but then making sure that you get accountants that know how to file it properly, because how you file traditionally and how you file a business trust and family trust and charitable trust and private family foundation is very, very different. And so it's not anything you want to just say, oh, I'm gonna let my accountant do it. He gonna watch YouTube or read a book. You need to really make sure that he understands the tax codes and the tax laws. But even if you don't have the trust set up, you can still borrow against the insurance policy for maybe a down payment on something or invest in an asset. But ideally, when you borrow against that insurance policy, it should be used to multiply the money. It should be used as an investment, not vacation. Or people, it's your money, so you literally can use it for whatever. But I really want to stress that needs to be used to multiply and make more money. Okay, so now, Sean, what are some of like your favorite insurance policies? Is it the whole life this your fave, or the IUL this your fave? And who wrote the book? What with the
Say that one more
Rockefeller?
time, Jewel. You broke up a little bit.
Also, who wrote the book of what
It's
was the
by Garrett Gunderson.
Garrett Thunderson?
It's by
THU?
Garrett Gunderson.
Okay.
Yeah, GARRETT GUNDERSON.
Okay, bet. Okay, thanks. All right. So which one are your faves,
Mhm.
IULs or whole life?
No problem. It really depends. You know, it really depends on a lot of things, right? I would say ultimately what you want to get the plan for, right? If you, depending on if you're risk averse or not, whole life tends to grow safely and permanent in nature. All the universal plans tend to have a little bit more aggressive growth in them. So it really kind of depends on your appetite, and I would say what you want to leverage the policy for. If I'm looking to leverage the life insurance policy to where I want that equity to be steady in growth, I would probably and a little bit of death benefit focus, I would probably level whole life. If I wanted some the potential for return, I would leverage some of the universal life plans. It just kind of really depends on your appetite. I have both. I have a lot of different types because I have a lot of different goals that I want to leverage the plan for. So it really kind of depends on what you wanted to use it for. And
Okay. So
and what I like
let's
about it is,
yeah. Go ahead.
no, I was going to say what I like about the equity inside of a life insurance policy is to your point earlier about using it for growth. It's really just math. Okay, so you have a life insurance policy and it may be growing at 5, 6, 7, 8, 9, 10%, depending on how you design it. But then you borrow your money from it. So you want to make sure, right, when you pull that money out, that you've done the math, you've done the research to where if I take out 40 grand and I put it into another project, that project is going to be giving you some return better than the rate at which you borrowed from, you know. And a lot of times when you do the math, most of the time, not all the time, um, there aren't other lending terms that can give you a better rate than if you were to borrow from a life insurance policy. So if you were to go to a bank nowadays, they may give you money at 6, 7%, right, depending on what the type of loan, right? But I would say 8 times out of 10, that rate is higher than the net rate of when you're pulling from your life insurance plan. So it's a lot of, I would say, just make sure it makes sense financially, mathematically, before you just, to your point, pull it out money, just kind of using it over here with no purpose or intention. You want to make sure you have a plan in place and that money is working for you to where when you get done with that project and you have some cash, you can put it back in the insurance plan and you're ready for the next one. You can be your own hard money lender, if you will.
Absolutely. So basically, what you do is you'll look at a person's age, you'll look at their health, you'll look at the monthly fee that they're actually going to start to pay into the premium, and then you'll kind of calculate the numbers and do an evaluation and come back and say, hey, this will get you, this amount of money if you invest this amount, or if you pay this for so many years. How many years on average do you need to pay into the average policy, or is it totally dependent on your age or what?
It depends on your age, your health, how much you put in, and I would say when you want to pull it out. There are some plans, if you design it correctly, where you can have money, access to the money after year one. Okay. But and then there are some plans where it takes 6, 7, 8, 9, 10 years. It all depends on how much you're willing to put in. And so think about it like a mortgage, since we're on the real estate track, right? So you have a 30-year mortgage, right? And normally the 30-year mortgage, the monthly requirement is cheaper or less expensive than the 20-year mortgage. Okay. So the insurance plan works very similar to where you can pay into it for an extended amount of time with lower premiums, or you can shorten that time with higher premiums. Okay. They have access to the same amount of capital.
Mhm.
So again, these insurance plans can be designed very uniquely. And so it takes someone like myself or somebody who's in the industry to ask really good questions to understand exactly what you're trying to achieve, and that they can customize the plan based on the goals and how you want to leverage that plan.
Yeah, and I think I know I asked you the other day. I don't know if you got a chance to take a look at it. I told you I paid into plan where I just paid into it for 5 years, an aggressive amount of money. And, now I don't pay into it anymore. I paid into it for 5 years. Then the insurance company is going to match it for 5 years. Then it's going to sit for another 5 years and accumulate. And then after that, I can start pulling, and I'll be able to pull every single year a certain amount of money being paid to me. IULs, so with whole life policies, I like it because it can work as a form of retirement for you. But now help me out a little bit. I believe the IUL, from a retirement standpoint, payment coming to you every single year after so many years, it's designed to keep paying you until you die. Then after you die, you still get a death benefit, but it'll just be reduced based on how much was paid out to you. Does that make sense?
Correct. Correct. That's yep. Yep.
Okay.
Yep. And a lot of our clients leverage. Go ahead. So
No,
yeah, a
no.
lot of our clients leverage that same leverage that same strategy that you just described. So two things I want to mention. Imagine if you had gotten your plan, or if somebody had put that plan in place for you 20, 30 years ago when you were a child. Because a lot of our clients, to where, in order to have the same amount of equity, you know,
You breaking up
depending on the
You breaking
budget, the people we work with, they'll take a few $100, putting inside of an insurance plan, only pay into it for 10 or 20 years. And a couple things happen at that point. They've locked in a guaranteed death benefit to be transferred to the family. Okay, because that insurance, you're done paying with it, that insurance is locked in, which is why the insurance company that you choose is very key. And then also, right, you're building up some assets or some cash that they can tap into when they graduate college, or when they want to buy their first house, or buy a car, or pay for a wedding. So you've already done the hard work for the child for the first 18, 20 years of their life. Now they're locked in with a wealth building tool that they can leverage in the future. And then on the back end of your life, like you mentioned earlier around retirement, right? Again, if you structure it the right way, when you turn 50, 55, 60, 65, you've built up this insurance plan to where you can tap into it free from taxes, because you're borrowing against it, and leverage income on a regular basis, right, as a part of your retirement strategy. And so people like that because it's going to continue to compound on itself. So it's almost functioning like a pension plan, if you will, or some type of annuity, or some type of social security that I don't really have a lot of faith in getting myself. So there's a lot of that. We call it a Swiss Army knife, because there's a lot of different methods and ways that you can use the insurance plan as a part of your wealth building strategy.
Yeah, and I like that. We used to do something called, I've got my license, but we got you on because I'm not really. I want to focus on building real estate. But when I was really pushing it about 8 years ago, it's something we call $1 million baby, where we encourage people to get, life insurance plans on their children, grandchildren. They're younger. You're going to get better death benefits for them. You got the policy on them, but then you own it. So you ultimately control the cash flow. So you can use those policies to not only just borrow after you got your babies covered, and then you also have access to cash. So you talk a little bit about that?
Mm-hmm. Yeah. So because they're minors, the parent or the adult is always going to be the owner of the plan until they decide to give it or transfer the ownership to the child. And people like that feature of the plan, because unlike some of the other investment accounts, like a UTMA or a UGMA, these custodial investment accounts, those accounts belong to the child when they turn the age of majority. Right here in Georgia is 21, and so they lose control of those investment accounts. But on the insurance, the parent or the grandparent remain the owner of the policy until they choose to transfer it over to the minor. And so I have one client there. We talked about their goals and the strategy. So what they want to do, they love real estate. And so they put a plan on their child. I think she's about 3 years old. And we did the math to figure out how much we need to fund it for them to have 50K in cash value when they're 18. Okay. And what she's going to do is she's going to take a portion of that 50K, look at the rental markets, most likely in St. Louis or Ohio. Buy a home. She's not hanging to it, but she then wants to use the cash flow from the rental properties to pay the premiums on the insurance plan so that it continues to build over time, right? And there's no money coming out of the pocket. The real cash value is going to grow. And so next year or the year after, when she turns 20, recycle it and continue to do that. So there's, again, a lot of different ways that you can structure it, but that's just kind of one example of leveraging the equity inside of a plan to build other assets. In this case,
when I say I love that, well, I love that. So how much are they paying a month to pay into the 3-year-olds?
I think they were doing, yeah, I think they were doing about $500 a month. And we did what we call overfunding, essentially where you have the minimum amount required. So for the insurance premium, but then you pay a little bit extra to build up the cash value faster. But it also provides a little bit of flexibility to where if a month or two you can't put in 500, you can dial it back to the minimum and still be okay. So she liked that more than just a normal investment account because it's a lot of flexibility.
Yeah, so the plan was to leave it alone for 18 years, and then when the baby turned 18 years old, buy her a rental property. She'll have $50,000 worth of cash. What would she do with the $50,000? Would she use that $50,000 to buy the rental property?
Yeah, as a down payment.
Okay, down payment.
Depending on the type of property, but in those markets, down payment.
Okay, so down payment, and then take the mortgage that's due and use. No. Okay, help me. Oh, she's going to take the tenant cash flow to continue to pay into the premium?
Yes.
Yeah, I like it.
Yes.
I like it.
Yep.
I like it. I like it. I like it. I mean, it's all about strategy, right? Now, imagine if she had, 4 children doing that. She might say, hey, I can't do, 500 on 4 children. Maybe it's $100 each on 4. The 5th we do 500. I mean, that's the beautiful thing about it. You can just get real creative, but now that's like the Bank of Odom, or the Bank of Grind, or the Bank of, Garland, whoever's on here tonight. You're now creating your own bank. And you keep doing it, and you look up and you're like, wow, we really ended up building a really nice situation. Okay, so just a quick review as we get ready to wrap the call, Sean. I'm glad you came on tonight. So whole life is going to be a little bit more conservative. Index universal life is going to be a little bit more aggressive in your investing. Do you have one that you feel like pays out better for those that want to use it as retirement?
Yeah. If you want something that pays out more aggressive, go with the universal life. IULs, index universal life, variable universal life. Some universal life plans tend to have a greater cash value growth potential. Okay, and so a lot of times I tell people that if you have a 5-year runway, to where you don't necessarily want to tap into it. If you kind of want to use it pretty quickly, or if you're risk averse, then the whole life would be kind of a safer route to go. But if you want something that give you some good growth and you kind of understand how investing works in really the case. It really kind of depends on a lot of factors, but typically, if you think about just for a second, the traditional stock market, you will make money. You just have to have time in the market for it to work out in your favor. So if you've got time, some good options, and then there's some protection mechanisms on some plans as well with caps and floors that you can leverage also.
Absolutely, absolutely. And then of course, we could talk about for some of you all that are, CEOs, you might want to do some key man policies as well, things like that. So listen, Sean, thanks so much for jumping on here. Y'all already know we dropping tea on here all the time, so you don't want to miss it. In the mornings, we got prayer. In the evenings, we got wealth. I mean, listen, it's a win-win. I want to encourage you, go ahead and get your tickets right now to the Monopoly in Real Life Conference next week, August 31st, September 1st in Detroit. It will not disappoint. We got some of the top industry experts that are coming in and not just talking about something that they do every now and again. We don't have like no part-timers. Everybody that we got on the platform are specialists. This is like what they do in real life, for real life. And so we want to encourage you to plug in, tap in. I know that's a holiday weekend, but that's a perfect weekend for you to say, let me get serious. Or everybody else barbecuing and eating, you're going to be at the Monopoly Real Life Conference getting game on what your next strategy is. Because we literally got like 5.5, maybe 5 months, like in 2 weeks left in 2024. And I'm sure if you're on here, it's because you're attracted to the scale up, you're attracted to increase, you're attracted to expansion. You're not following me, you're not listening to this because you're trying to be regular, right? There takes a degree of obsession to really be successful in anything. And so you have a lot of people that are obsessed with what we're doing that's going to really be able to help you get to the next level. So Sean, thanks so much for coming on here tonight, brother, and dropping that tea. Get your tickets right now, monopolyconference.com. It's going to really set you up. And the sooner you start, the better. Let me ask you this last question before we get ready to wrap. For somebody who's saying, listen, I don't have $500 a month, what's the minimum would you say somebody should be thinking about that they need to start? Because I know a lot of times people are like, okay, I'm going to wait till, little Johnny graduate, or I'm going to wait till this. But I really feel like when it comes to some of these baseline, foundational wealth principles, what would you say? Bottom line, you need to tell yourself, I'm paying into this policy every month. What's the minimum they should really be thinking about?
I would say minimum probably $50, right? I'm a firm believer of something is better than nothing, right? And so what we hear all the time is I'm gonna wait, like you said, I'm gonna wait until I get my money together. I'm gonna wait until I pay off some debt. I'm gonna wait until you do those things, which is fine. But insurance is one of those things that depend on your age and your health. Okay. And so you wait next year, we don't know what your health is going to be like. We know you're going to get 1 year older, right? But we don't know what your health is going to be. And so if you're really serious about building wealth, if you're looking for a way to transfer wealth, I would say start with something. And if you can do 50, great. If you can do more, that's even better, right? But I would say start with something.
Yeah, that's really good. Start with something. And even if you're in really good health, the older you get, the less they're going to be paying out, the more you got to pay in. So it's definitely not something you need to be like, I'm going to wait till next year. Every year you get older, the insurance company dings you for it, even if you're in good health. You see what I'm saying? They're going to ding you for it. So you really got to get serious. And honestly, you need to be thinking about the babies in your family. And then also your parents, right? Your grandparents in some cases. Go ahead and grab that policy. It may not be as much, but I'm going to tell you right now, I had a term on both of my parents, and I wish that I would have had a whole life on them, because now they're like aged out. So what I've done is said, okay, let me go ahead and get this property. So this property is going to take care of my mom. This property is going to take care of my dad. If something comes up, I can always, cash out if I want to. And I just use that monthly income that's coming in as kind of like my parents' account to handle when that time comes. They do have their own insurance, but I wanted to make sure I had insurance. But had I had to do it all over again, I would have got them whole life, because I had them term policies for 15 years, and that 15 years went by. Thankfully, my parents are still living, doing well. But then when I went back and said, hey, Can I re-up? It just didn't even make sense. Like it was just way too expensive. It was like, child, just going to grab a single family or duplex and let that house be assigned to my parents.
Mhm.
So really think about when you think about insurance, Katie, think about not just you, your children, your grandchildren, especially when they're younger, grab it, but go ahead and grab it maybe for, your parents and in some cases your grandparents and just hold it because you are the owner of the policy, Nicole, you still have access to all the cash, which is a good thing. So Sean, thanks for jumping on here. I appreciate it. Y'all get your tickets to Monopoly Real Life Conference. Cannot wait to see you August 31st, September 1st. Bye, everybody. See y'all later. Thanks, Sean. See ya.